Welcome to our second Q&A for 2021, and it's actually going to be a really good one because it's a question from someone which covers a lot of ground. And this Jen has sent in his question, which is actually quite a series of questions, if you like, and it's really well thought out. He's obviously spent a lot of time going through this because, let's face it, I mean, these are pretty important issues that we as expats living around the world quite often face. So I'm going to go through it in a bit of detail, and I'm actually going to do this in two parts, with one part this week, and I'll try and cover the second part of it next week because there is really quite a bit to go through. So if you have a look on the whiteboard there behind me, this gentleman's living in Asia, an Australian expat, and he said, look, I may potentially go back in 5 years' time. So I've thought about wealth creation strategies, and here's one of mine. Here are my thoughts. I'm thinking perhaps I can buy an investment property each year for the next 4 years, valued at around $500,000 with a 20% deposit, and then at the end of year 5, I'm going to buy something that's more expensive, and it's going to be a future home that I'll want to live in. So, that's quite concise, important there to look at those things. Saying, is that the right strategy? Well, depends on many things, so I'll come back to some of the assumptions that he's making and some of the things we need to think about. And then he also said, look, I'd like to keep stamp duty as low as possible because, it can cost $20,000 to $30,000 up front, and I just find that a really terrible thing to sort of to stomach. So let's think about it all. Okay, first up, I may potentially return in 5 years. That's really a difficult thing then. It may be longer, he may not return for perhaps more than 5 years, 10 years, who knows. So we've got to think through and make sure that we're doing these things for the right fundamental reasons, instead of perhaps coming to just a time frame and working with that. Then the other thing is, how do you work out whether buying one property for $500,000 each year for the next 4 years is the right strategy? And the 20% deposit's important because later on in his questioning he talks about, I want to cover the mortgage payments with the rent. So let's look at all of that in its own right. And I guess it's important to say, rather than putting just the price point on the property that I'm going to buy, what are the other attributes of that asset that I'm going to acquire? Really, that's what you should be doing, because rather than just saying, look, I'm going to buy, this asset for whatever amount of money, regardless of what it gives me, I want to buy the best quality asset that I can afford to buy. And that generally, I find, gives you a better outcome. So, let's look through that. The stamp duty side of things, gosh, it's just part of the whole process of acquiring property. And if it makes you feel bad, then simply add it to the price of whatever it is you're buying and say, look, that's going to be long forgotten when the property goes up in value, and whatever, in a decade's time or more, whenever the property has doubled, you're not going to be worrying about having paid 4% or so in stamp duty. So I think don't make that a major issue, because sometimes people can overcomplicate these things and they can get too caught up in the minutiae of the data to actually make wise investment decisions. And that's what you've got to do. Step back. Great to do your research, great to know all the numbers and look at the quantitative outputs, but at the end of the day, you've got to make smart decisions about the actual asset that you're buying. And that's far more important. So let's say, for example, that in this perfect world of ours, over this 5-year period, instead of buying 4 properties for $500,000 a year, we only managed to buy 3, and they were $700,000 each. Well, one was $800,000, one was $600,000, and one was $750,000. At the end of the day, the price of each is irrelevant. It's what the outcome is going to produce over time. That's what we're after, isn't it? We want these things to grow in capital value and give us a reasonable income, be easy to rent, etc., etc. So the second part of the question was, what about capital gains tax? What to look for in an investment property at that price that people will still want to live in 20 years' time. Well, let's just go, instead of fast backwards and say, what do people want to live in now? And generally speaking, because human nature doesn't change that quickly, certainly not in 20 years, perhaps in millennia, but people still want to live in something that's attractive to them, that's well located, that has amenities around it, all sort of things that we would want to live in, all of us. And the person asking this question would be the same. So, don't forget the basics, and we say it's as easy as pie. So that's saying that it should be located somewhere where you have population growth, infrastructure growth and employment growth. Now, that's obviously of a long time frame. If you can put all that together, buy a quality asset in that location, in a sought-after area, and have some sort of unique attributes to that. Now, that may be a view, that may be the relativity of that particular property within a building, or, proximity to perhaps schools and entertainment precincts that others don't. They're all the things that people have a desire for now and will have a desire for later. So you don't have to be a rocket scientist. You can just make sure when you're doing your due diligence up front now that you look for those things. And if you get them, you're going to have a great asset. And it's still going to be a great asset in 20 years' time, except it'll be worth a lot more money. And people will be paying you more rental income, because rent generally goes up at least at the rate of CPI, if not more. So that should cover that off. And then the second part of that is, when should I sell? And the beauty about capital gains tax, of course, is that it is based on a transaction. So you have to sell to actually be forced to pay some capital gains tax after the event of that transaction. Now, when do you sell? Well, if you have no good reason to sell it, then the answer would be, don't sell it. And people say, well, what, never sell it? Well, that could be the case. Let's look at it. Let's say you buy a property for $1 million now, and in 20 years' time it's worth $3 million as an estimate. So that's all well and good, but the rental income that you're getting now, let's say it's $40,000, now that may have gone to $120,000. So it will throw off far more free cash flow because your debt level has not increased over that time. It has probably decreased because you wouldn't keep it at interest only for 30 years. So at some point in time you've reduced the debt to a low level or to zero, so that's all free cash flow. And I'm thinking, as most people do, when you stop working and creating personal exertion income and you retire, or you work flexibly, you want other income. You want income from passive sources, and property is a very good one. So if that's giving you a growing source of income and is also growing in capital value, then you don't really have a need to sell it unless you've got a better use for your funds, or unless there's some kind of calamity that strikes that you need to sell. So that's something to bear in mind, a really simple way of managing capital gains tax problems that people often worry about, and most of the time I say needlessly. So then another part of the question was, what about my portfolio mix strategy? Don't forget he had the idea of buying one property per year for 4 years at $500,000 and then one to live in at the end of year 5. And the thing is here, he would like to cover the mortgage payments with the rental I receive. So, should I focus on a mix of high income and high capital growth properties? Well, and I find this actually more so quite often with people who have been expats for a long time, rather than people living back home in Australia domestically, or even short-term expats, because most people in Australia, up until very recent times, were used to living in an interest rate world that was higher than most parts of the world. So, 5% was a very cheap rate, and we're far more used to paying 7.5% or 8.5% interest, unless you went back 20 years, in which case you could be paying 17.5% or 18.5% interest. So people always thought that if you're going to buy an asset, now whether it's $500,000 or $1 million, of course you're going to be contributing some money to actually buying that asset. But I find when you're in other parts of the world, perhaps especially in Asia, a lot of people have this notion that it shouldn't cost you anything. and I'm not sure where that comes from, but whilst it is definitely the case at the moment, it's not going to remain like that forever. So covering the mortgage repayments with the rental, it's nice, but it's not certainly something that I would look for as an investment strategy, because it doesn't tell me anything about the asset except that perhaps I'm buying something that may not have good capital growth. And the reason for that is that generally there's a trade-off. There's a trade-off between capital growth and income on many assets. So the higher the quality of the asset, and generally the more expensive, the lower the yield. But let's look at all of those things and break them up, because the idea is obviously to have higher growth, which is a good thing, because as I've said, you don't get taxed on that unless you actually ever sell the asset. So higher growth is obviously really good. Income is useful in meeting the debt servicing obligations, absolutely. So you want to buy something with a decent yield, because the flip side of that is, if you buy some old property that needs a lot of repairs and maintenance and gets a lower yield by sheer definition, that could be a bit of a problem for you. However, if you go the other way and look for high income properties, that's not really a great strategy, because anything where you've got positive income, so above a neutrally geared situation, is particularly bad for an expat, because it's going to be taxed at 32.5 cents in a dollar from $1. So we're not trying to create extra income. Most expats actually have a pretty good income as it stands. So the real reason to buy investment properties that have a higher yield, and I'm not talking about high yield, I'm talking about a higher yield, is to help you get a higher borrowing capacity from the bank or the lender that you're approaching, because that's one of the areas that we perhaps find a little bit more difficult. So really important to think this through and try and get into your head. Just swap seats. Look at, if you were the person renting something instead of you being the landlord and owning it, what's a tenant going to look for? Well, probably the same things that we look for, perhaps as tenants being expats. That building over there is really nice and new, has great views, quality finishes, nice entrance and amenities, and it's well located, close to transport, close to where I need to go. Great, that's what I want. So obviously, if you buy a property like that, you're going to find it easier to rent that to quality tenants, generally speaking. So that's what you're trying to look for, basically. So when you're building a property portfolio, don't be too rigid in this. This was really well thought out, by the way. This person's put a lot of thought and effort into it, and I commend them for it. But don't be too rigid, because when you say, I may potentially go back in 5 years, let's say it's 7 years. So, you could be shooting yourself in the foot by saying, I only want to spend $2 million, i.e. divide that by 4, it's $500,000 per year for 4 years. You may be able to acquire perhaps the same number of assets at a higher price, or more over time, as it passes. You might be offshore, as often happens then, for 10 or 15 years. So try to buy the best quality asset that you can afford comfortably from the beginning and see how you go. Because I still think that will give you a better outcome than just trying to buy quantity. Feel the quality rather than the width, as I say. So they're all the things that really we need to think about. And then next week on our next Q&A, I'm going to touch on some of these other issues that people have brought up alongside of this, and I'll go through the rest of this gentleman's questions because they're really good, and we might do a little bit of a sort of practical session, because at the moment, covering your mortgage payments with your rent's actually not a difficult task. So let's say you have $1 million asset and you've borrowed $800,000 and your interest rate on the $800,000 is, say, 3%, $24,000 per annum, and your yield's 4% in rent, $40,000. So even after other expenses, it's not too difficult to have your rental income match your outgoings. And really, I'll leave people with that as something to contemplate and think about, but that's not the name of the game. The name of the game is obviously to buy things that when you look back in 10, 15, 20, 25 years' time at the different things you've purchased, you think, wow, that was actually not a bad situation. I'm keeping on getting increasing income, and the value of that asset is growing nicely without there being any major cost issues involved. So no major renovations, etc., that I need to undergo to maintain that asset base. I hope that's been helpful in a lot of ways, because we get these sort of questions in a far less structured manner than this, but people still think about it. So it's something that obviously we all, feel is important, and I hope that covers it off until next week. All the very best, and I look forward to seeing you at our next Q&A.